Hello everyone, you are watching Saheb Academy. If you like our videos, then please subscribe to our channel and also hit the bell icon for the regular updates, and also follow us on Instagram, Saheb Academy. Now let's go to the video.
Hi everyone, in this video we are going to discuss about the journal entries, and we are also going to understand how to pass the journal entries logically, okay, with the rules of debit and credit. Yeah, and we have also to understand what does debit and credit mean. That's the most important thing. Yeah, that's where the most of the students are confused about. What does debit and credit mean? They think debit is good, credit is bad, something like that. Debit is plus, credit is minus, something like that. They have all these misconceptions about the debit and credit. So we are going to clear all that, and we are going to understand properly and logically how to pass the journal entries. And believe me, if you understand the journal entries properly, right, then all the chapters which you have, all the chapters in accountancy would be a really piece of cake for you, because this is the foundation. If you understand debit and credits and this journal entries, in all the chapters you will have in the later studies also, you will find everywhere journal entries are there, because this is the primary part of accountancy. In accountancy, what you do in accounting, first you record all the financial transactions. Yes, first you record all the financial transaction, and then you classify them into structured format, and then what you do, summarize them into financial statements such as profit and loss statement, balance sheet, cash flow statement, and so on. Yes, so the first step of accounting is recording the financial transaction, isn't it? So that's where the journal entry comes in. Yeah, to record any financial transaction, what does accountant do? Accountant passes an entry in a book called journal book. Yeah, he passes an entry with debit and credit in a journal book. That's how the recording is done of every transaction. Yes, first the accountant would need a source document. What is source document? An evidence of the transaction. It can be a voucher, it can be a bill, it can be a receipt, a bank statement, yeah, which proves that that transaction has happened actually. Yeah, so from that evidence, the accountant makes an entry in the journal book. He makes the recording. Yeah, that's the recording step. And then summarizing and all that. Yeah, classifying, summarizing financial statements and all that. So this is the accounting process. Source document, journal, ledger, trial balance, and then financial statements such as profit and loss statement, balance sheet, cash flow statement, statement of changes in equity, and all that. Yeah, but here in this video we are concerned about the journal only, how to pass the journal entries. Yeah, and I have a very special trick for you to understand this properly and logically. Okay, so easily you will be able to pass the journal entries, don't worry. So let me just show you the rough format of journal. See here, this is the format we have. Date column, particulars column, where you will pass the actual entry. Yeah, this is the entry here, cash account debit to capital account. Yeah, you don't have to understand here anything, I'm just showing you here. Yeah, this is the entry, and this is the narration, the description of this entry. What does this entry mean? Yeah, being started business with cash. This is called narration. Understood? Okay, then we have this LF column. What is this LF? Ledger folio. This is just a page number of this book, ledger book. All right, just a page number for the reference. Yeah, where does this transaction has been recorded in ledger? To find that, we have a reference. Yeah, we have a reference number here. That's called ledger folio, just a page number. Then we have debit and credit. These are the two columns, where you write the amounts. Yeah, and it will always be equal. Okay, debit will always be equal to credit, because in accounting what we do, we follow double entry system. Yeah, so in double entry system what we say is every transaction has two effects, a debit and a credit, and both of them have to be recorded. Yeah, and it will always be equal. Debit is equal to credit. Okay, yes, so this is the rough just format I wanted to show you, just you can get an idea what are we doing over here. So this is the journal, this is the entry. We have to learn how to pass these journal entry, and what to debit, what to credit, you have to understand that. Okay, so you will understand that once you understand the rules of debit and credit. Okay, so let's go there. Yeah, let's see how to pass the journal entries. Let's see the rules of debit and credit. We have modern approach, so we have to see this modern approach. Let's see the modern approach. Now here we have the modern approach, or you can say modern classification of accounts. Yes, we have 6 classification over here. See, DEALER, dealer, right? So first let's understand what does each of these alphabets stands for, and then the meaning and the logic behind it. Okay, so once you understand this technique properly, yeah, then you will be easily able to pass the journal entries with no difficulty at all. Yeah, so let's do this. Let's understand this. See here, D stands for drawings or dividends. Now you will say we don't know the meaning of that. What does drawings or dividends mean? See, it's very simple. When the owner invests the money into the business, that's called capital, isn't it? When the owner invests the money into the business, that's called capital. And when the owner withdraws the money takes the money back for his personal use, that is called drawings. Clear? Capital and drawings clear to you? Yes. Yes, this will happen in a partnership business as well as single owner business. Yeah, the capital will be called capital and drawings. Yeah, but then when it comes to companies, in companies what happens, the capital is divided into small units called as shares. Yeah, why? Because in company there is not a single owner, there are thousands and thousands of owners, right? In joint stock companies I'm talking about. Yeah, so those owners are called shareholders. Yeah, what will happen is the company will issue the shares in the market, then the people, they will subscribe to these shares. Yeah, they will pay the money, and that's called contribution to capital. That's how they will contribute to the capital of the company. They will buy the shares. By buying the share, what will happen, when the company issues for the first time IPO, yeah, what will happen is these people, they will become the owners of that company, and they will be called shareholders. Okay, and there will be hundreds and thousands of them. So now here, as I said, here we have shares concept. So now here, what these people get, they get dividends in form of return. Okay, because they have spent the money. Yeah, they have contributed to the capital of the company, isn't it? So now they should get something in return, right? So whatever profit the company makes, a portion of that, okay, a portion of that is distributed among the owners of the company, the shareholders. Yeah, and that is called dividends. Whatever that is distributed by the company to the shareholders. Okay, that is what is dividends. And as I said, here we don't have single capital, here we have share capital. Okay, so here we have equity share capital and preference share capital. Okay, these two types of capital we have. Okay, and in total we call them just equity. Remember that. Okay, E stands for equity or capital. Okay, you clear with this equity or capital? Yeah, so now we are clear with two different concepts, D and E. Yeah, drawings or dividends. Yeah, drawings mean whatever the owners, they withdraw from the business, whatever money they withdraw, that's called drawings, and whatever the shareholder, the owners get in the companies, that's called dividends. So drawings or dividends, the meaning of both these things are same only. Whatever the owners gets, that's called drawings or dividends. Yeah, dividends in form of company, drawings in form of single owner business and partnership business. Clear? So you are clear with drawings or dividends? Yes. Okay, then we have E for expenses and A for assets. So first let's understand what does asset mean. See here the definition of an asset. An asset is a resource controlled by an entity as a result of past events and from which future economic benefits are expected to flow to the entity. Now what does this mean? We didn't understand anything from this definition. Don't worry, I will give you a simple example. See here, machinery, trucks, buildings, furniture, computers, all these things. What are these things to the company? These things are asset. Why they are an asset? Because the company has control over it. Yeah, either they have purchased it or they have got it on rental basis, yeah, lease basis. So they have control over these things and there is future economic benefit from them. Yeah, what does future economic benefit mean? See here, the company has purchased this machinery. So now this machinery will be useful for, let's say, 5 to 6 years, right? So they will use that machinery in production and they will produce some products, yeah, and sell it in the market and generate sales. Yeah, they will do sales and they will generate revenue. So this machinery will be helpful to conduct the operations of the business, isn't it? So there is economic benefit, not only economic benefit, future economic benefit. That's the main thing about the asset. Now these trucks, the company expect the trucks to work for, let's say, 10 years. Yeah, 10 years or 8 years, whatever is the useful life. Okay, so they expect that these things will be useful to the company for many number of years in future. Yeah, so future economic benefit is there from these things, furniture, let it be building, whatever it is. Yeah, they will use the building for the space, commercial space, yeah, to do the business, isn't it? Yes, so that's what an asset is. It is something that the company has control on, and then there is future economic benefit. If these two things are there, then that's an asset. Simple as that. So you should be able to recognize what is an asset and what is not an asset. Yeah, so if I say anything, any word, you should understand in which category it falls in. Okay, all right, so that's what an asset is. Okay, control and future economic benefit. Then we have to understand what is an expense. Let's do that. See here, expense. An expense is the cost of operations that a company incurs to generate revenue and from which no further benefit is expected. Yes, that's what an expense is. Expense is the cost or expenditure that you incur to run your operations of your business smoothly. Yeah, you pay the rent of your business, you pay the electricity bill, you pay the salaries of your workers, and then you pay the telephone bill, and all these things are expenses. But now you have to understand why these things are expenses, yeah, why they are not asset, why they are not liability. You have to understand this thing properly, so that's because expenses have no future economic benefit. That's the main thing about expenses. If the expense has been incurred, that means you have already taken the benefit. Yeah, you are paying the, let's say you are paying the rent of January. Yeah, you will pay it at the end of the January, isn't it? So that means you have already taken the benefit. You have lived there entire month of January, and then at last you are paying the rent. Yeah, you are paying the electricity bill. You are paying the electricity bill at the end of the month, isn't it? Yeah, you have already taken the benefit of the electricity. Then in the next month again you will have to pay. But that's not the thing with the asset. If you remember, asset has future economic benefit. If you purchase the machinery today with, let's say, 1 lakh or whatever the money it is, yeah, then you can expect that this machinery will be helpful for you. It will have future economic benefit, isn't it? You will be able to use it in your business for, let's say, 10 years or so. Yeah, it has future economic benefit. That's why machinery is an asset. But this are the expenses: rent, electricity, salaries, and all these things. Why? Because there is no future economic benefit. If you pay 2,000 electricity bill today, yeah, then again in the next month you will have to pay another electricity bill, isn't it? Let's say you pay 2,000 electricity bill. So then can you expect that you will receive benefit from that 2,000 in the next month also? No. The benefit of the 2,000 which you paid today, that's for this month. Yeah, in the next month again you will have to pay the electricity bill. So basically, expense is what? There is no future economic benefit. The benefit of something which you have already taken up, that's what an expense is. That's the core thing about the expense. No future benefit. Yeah, asset have future economic benefit, expense do not have future economic benefit. Clear? So you should be able to know what is an expense, what is not an expense. Okay, telephone bill, shipping charges, all these are expenses, because once you pay them, again you will have to pay them whenever you need the benefit. Yeah, you will not get the benefit once you pay them. Yeah, you have already taken up the benefit. Clear? It's simple. Yes. Then let's understand what is L, liability. See here, liability is what? Liability is nothing but just a financial obligation. Okay, that's all liability is. You owe money to someone, then that's your liability. See here, a present obligation of the entity to transfer an economic resource as a result of past event. For example, yeah, you went to a bank and you got a loan, right? So now you have the money, but now immediately you have an obligation also. Yeah, you have an obligation that in future you have to pay that money back, isn't it? You have to pay that money back to the bank, isn't it? Yes, so that's a financial obligation you have now, present financial obligation because of the past event. Past event means you went to the bank and asked for a loan, yes, and you got the loan. So that was the past event, and in future you have to transfer an economic resource. Economic resources, you have to pay something, you have to pay cash, yes. So that's what a liability is, simple as that. Okay, loan, creditors. If you purchase goods from someone in business, yeah, and you don't pay money, then that person from whom you have purchased, your supplier, he will be called as creditor, because now you have to pay to that person, and that person will be called creditor. Okay, the person to whom you owe the money, that person is called creditor. Simple. So that's what liability is. Okay, you have a financial obligation because of the past event and you have to pay or do something. Okay, simple as that. That's what a liability is. Then let's see the capital. Now you already know what capital is. Capital is nothing but the money which is invested by the owners, right? See here, E for equity or capital. Yes, the money which is invested by the owner, that's called capital. Simple as that. Yeah. In companies, what we have equity share capital and preference share capital in joint stock companies. So commonly we call that as equity. Yeah, equity or capital, the same thing. Okay, it's not different, it's same thing, right? Then we have revenue or income. See here, revenue. Revenue means what? Revenue means income. Yeah, how do you earn the money? Now in business, how do you earn the money? Either you make sales, right? That's how you earn the money. You sell goods or services, and that can be as well as on cash basis as well as on credit basis, isn't it? Yes. And then what do? If you have space in your company which you don't use, then you will rent it out to somebody else, a third party. So from there you can receive rent, isn't it? So rent received would be your revenue. And then if you have invested money somewhere and you are getting some returns out of it, you are getting interest, whatever it is. So then interest received, that will also be your revenue, isn't it? And then there are so many things. Discount received, yeah, if you're purchasing something and you get discount, then that's also your revenue. Yeah, so all these gains, benefits which you get, yeah, all this income, these are revenue, but mostly sales is revenue. Okay, so that's it. Yeah, that's the revenue is. So now we have understood each and everything over here, all these words: drawings, expenses, asset, liability, this equity or capital, revenue or income. Yeah, so now we have to understand the rules of debit and credit. Yeah, let's do that. So the rules of debit and credit are very simple. See here, what we have over here is this word, right? Dealer. So now I have drawn this here, this dotted line. Why? Because this is one group and this is another group. Okay, we have two groups over here, and this group of drawings, expenses and asset, DEA, this has debit balance. Okay, this has debit balance, and liability, equity and revenue, they have credit balance. Fine. Now don't ask me why, okay, because there is no logical explanation for that. It's just is from the beginning. Okay, it's just a rule. Fine. So these people have debit balance and these people have credit balance. So to increase drawings, expenses or asset, yeah, what you have to do, you have to debit them. Yeah, to decrease them, you have to do opposite, you have to credit. Yeah, and it is opposite here. They have credit balance, so to increase these guys, you have to credit them, and to decrease them, you have to do opposite, you have to debit them. Yeah, that's what the trick is. It's very simple. See, modern rules of debit and credit. Drawings have debit balance, expense have debit balance, asset have debit balance. Yeah, so to increase them, what you're going to do, to increase them, you are going to debit them. Yeah, debit, debit, debit. Yes, and to decrease them, opposite of that. Yeah, for example, you have purchased the asset, so asset is increasing. Yeah, so immediately to increase the asset account, what you're going to do, you are going to debit that. If you have sold the asset, asset is decreasing, so you need to credit that asset account, whatever asset you have sold. Yeah, that's how you have to debit and credit. Now you will be getting the idea that what does debit and credit means. Debit and credit doesn't have any meaning. They don't have any meaning. These are the two abstract terms we use in accounting to reflect the duality concept. Here we have double entry concept. I told you, right? We record every transaction with a debit and a credit, and both the effects of a transaction, debit and credit, are always equal. Okay, so see here, then here we liability, equity and revenue, these people have credit balance, so to increase them we credit them, and to decrease we do opposite, debit, debit, debit. Yeah, for example, if you took a loan from the bank, then your liability is increasing. So to increase the liability, what you're going to do, you are going to credit the bank loan account. So the main thing is the classification. Whatever item you have, furniture, what is furniture? Furniture is something you own and future economic benefit is there, that's an asset, so these rules will apply. Yeah, bank loan, what is bank loan? Bank loan means what you have to pay, right? So that's a liability, so these rule apply. Yeah, so now capital, what is capital? Capital is equity or capital. Yeah, this rule will apply. So whenever the capital comes into the business, capital is increasing, so you have to credit the capital account. So you need to know, you need to know the classification properly. You should be able to classify everything into these 6 items. Yeah, whatever it is, furniture, car account, yeah, computers account, whatever it is, land and building account. Now where does land and building comes? Asset. Because you can use the land and building, there is a future economic benefit. Yeah, you own it or you have it on lease basis, whatever it is. Yeah, you have control, you have future economic benefit, then that's asset. So this rule will apply, isn't it? Yes. So this is what we have, these 6 things only. Okay, you should be able to categorize whatever you have into these 6 items only. Yeah, if I tell you electricity, then where does electricity comes? Here in expenses. Yeah, whenever you have to pay the electricity bill, the expense is increasing, you have to debit that. Yeah, simple. Yes, and if there has been an error in recording the expense and you want to reverse that error, then what you will do, to decrease the expense, you will credit that. Yeah, mostly the expenses, they never decrease, but sometimes some error will happen in recording, so to reverse the effect, you have to credit that. So this is the rule, simple rule. Yeah, whichever things has debit balance, to increase them you have to debit, and to decrease, opposite, do opposite, credit that. Yeah, so debit and credit doesn't mean anything. Yeah, it doesn't mean debit is good, credit is bad, something like that, or plus minus. No, it depends upon the balances these elements have. If they have debit balance, to increase you have to debit, to decrease you have to credit. If they have credit balance, to increase you have to credit, to decrease you have to debit. Now don't worry, we'll solve a problem and we'll see practically how to use these rules properly and prepare the journal entries, pass the journal entries. Yeah, so this word will be helpful for you to remember all this. Dealer, yeah, drawings or dividends, expenses, asset, liability, equity or capital, revenue or income. Yeah, now don't go on looking the reason behind why these guys have debit balance and these guys have credit balance, okay? Because certain questions cannot be answered. Yeah, if I ask you why milk is white, can you tell me? There is no reason for that. It's just is. You just have to understand. Yeah, from the beginning it's just is. Yeah, why sky is blue? Yeah, there is no reason for that. It's just is. You have to just take it. Yeah, these guys have debit balance, these guys have credit balance. That's all. Yeah, yes. So this is the rule. So now let's pass some journal entries and let's see how to use these rules practically. Yeah, let's go to a question. Now here we have got the question. See the question over here. Journalize the following transaction. We have got these 10 transactions over here and these are simple ones. Okay, I have taken simple transaction just to start off this journal entries thing. Yeah, so before passing the journal entries for each of these transactions and making the recording in journal book, before doing that, let's just see this technique of journalizing. Yeah, see here, whenever you see a transaction and you want to pass journal entry of that transaction, first what you have to do is, first you have to analyze the transaction. What is happening in that transaction you have to see. Yeah, then the second step would be you have to identify at least 2 accounts that are involved in that transaction. Yeah, that transaction, because of the transaction, which 2 accounts are getting affected you have to see, and there would be at least 2 accounts. Yeah, always, because here in accountancy what we do, we follow double entry system. Yeah, what does double entry system says? It says that each and every transaction will at least affect 2 accounts, and every transaction will have a debit and a credit. Yeah, 2 effects will be there. So, and the effects of debit and credit will always be equal, but then the accounts will be at least 2, or it can be more than 2 also. Yeah, but at least it will be 2. Fine. So you have to identify at least 2 accounts that are involved in that transaction. All right, and then you have to see in which category they fall in. Yeah, in which classification they fall in. Now I've already explained you, right? Dealer, how many classification do we have got? We have got 6 classification, right? Dealer, drawings, expense, asset, liability, equity, revenue. So we have to see our account falls in which category. Yeah, furniture falls in asset account category. So this rule will apply like that. Yeah, so first identify at least 2 accounts and then see in which category each of them fall in. Yeah, what will happen sometime? See, furniture purchased. Yeah, if you purchase the furniture, then furniture is an asset. Yeah, and then if you purchase the furniture with cash, then cash is also an asset. Yeah, because they have future economic benefit and the company owns them, right? So both are asset. So this rule will apply. Yeah, so then you have to see whether they are increasing or decreasing. If they are increasing and it's an asset, you have to debit. If it is decreasing, you have to credit, like that. Yeah, you have to use the rules, dealer rules. Yeah, these rules, modern rules of debit and credit. Yeah, so this is the technique of journalizing the transaction. Fine. So now let's solve this problem. Okay, now too much chit chat. Now let's just solve this problem. Yeah, let's just pass the journal entries. Yeah, so the first transaction here we have got is David started business with cash rupees 1 lakh. Yeah, so this transaction here, from this we come to know that this person has started the business with cash 1 lakh. Yes, so 2 accounts that are involved. That's what you have to see. The first is cash, no doubt about that, because in this transaction cash word is coming, so cash account is affected. Yeah, and then the second one would be what? Here the business is being started and he is the owner, he has invested the money, so capital account. Yeah, so capital account is affected. These 2 accounts are affected, a cash account and capital account. Now capital account, we already know it's equity. Yeah, equity or capital, so this rule will apply. And then what is cash? Cash is an asset. Yeah, the company owns that and company has future economic benefit from that, because company can do whatever it wants with that cash. Yes, so it is helpful for them in future, so that's an asset, right? So asset rule will apply. So now what is happening here? Is cash increasing or decreasing? Cash is increasing because cash is coming into the business. Now here you are passing the journal entries as an accountant. Yeah, accountant of this business. So you have to see from the point of view of business. All right, point of view of business. Fine. So cash is coming into the business, cash is increasing. If cash is increasing, you have to debit. Yeah, asset is increasing, debit, right? So cash account will be debited. And then capital is also increasing. Yeah, In the business, capital is coming in, so capital is increasing, so that means you have to credit the capital account. So now how are you going to present this in the journal? See here, it's very simple. See here, cash account debit, yeah, cash account debit, and then yeah, below that you will take to capital account. To capital account means what? It is credited. Okay, you will leave a bit space over here, cash account debit, some space, and then to capital account. Fine. So 1 lakh, 1 lakh. Yeah, cash account is debited. Yeah, this dr means what? Debited. Now you will say, why are we using dr dot? See here, debit received, like that. Okay, it means like that, but you know, we use this acronym always. Okay, for debit dr dot, and for credit cr dot. Fine. So cash account debit 1 lakh, capital account credit 1 lakh. Simple. Double entry system, debit is always equal to credit. Yeah, each and every transaction will have two effects, a debit and a credit, and always they will be equal. Yeah, it will be equal, and then it will at least affect two accounts. So that's what. Yes, you clear with the first transaction? Yes. Then the second transaction we have is, see here, paid into bank 70,000. Now what is this? Paid into bank 70,000. It means that the owner has deposited the money into his bank account 70,000. So now here two accounts are affecting. Which ones? Tell me. The first is bank. Yeah, bank account is increasing. Yeah, because the money in the bank account is increasing, but then cash in hand, the cash is decreasing. Yeah, because you have deposited cash into the bank. So these are the two accounts that are being affected, bank account and cash account. Yeah, and what types of accounts are these? In which classification, in which category they fall in? Cash and bank, both are asset account. Yeah, both are asset account. Yeah, so these asset account, what will happen? If they increase, it will get debit. If it decreases, it will get credited. Yes, so here cash account is getting decreased because we have put the cash into the bank, and bank account is increasing. So bank account is increasing, asset account is increasing, debit the bank account, and then cash account is decreasing. Yeah, asset is decreasing, credit the cash account. Simple as that. So the entry would be bank account debit. Yeah, money is increasing in the bank account. We have deposited 70,000 money in there, but our cash in hand, the cash has been reduced. Yeah, so to cash account it will be credited. Yeah, 70,000, 70,000. Simple. Yes. Then the third transaction, see here, bought goods for cash 5,000. Now let me tell you one thing. Whenever you purchase the goods, right, for resale, yeah, to sell the goods, whenever you purchase something to sell in your ordinary course of business, then you will not use the term goods or like that. Yeah, what you will use is, you will use this term. Okay, purchases. What? Purchase, but not purchases, purchase account. Fine, purchase account. And whenever you sell something, yeah, and those are your goods, then you will use this term, sales. Fine, sales account. Yeah, in the ordinary course of business. Fine. Yes. So here what is happening? Bought goods for cash 5,000. You have purchased goods worth 5,000 rupees. Simple. What is happening? Two accounts are getting affected. Which ones? A purchase account. You are purchasing the goods to sell them. Yeah. And then what? Cash account, because the cash is getting reduced. You have bought that for cash. So cash account is getting reduced, and purchases account. What is purchases account now? Purchases is an expense account. Okay. It's an expense account. Yeah. So that is also increasing. Yeah, purchase account is increasing, but cash account is decreasing. Yes, so the entry would be simple. Purchase account debit, expense is increasing. If expense increases, you have to debit that. Yeah, expense account. So purchase account debit 5,000, and then cash is decreasing because you have paid the money, right? So your cash is decreasing. Cash is an asset account. If it is decreasing, you have to credit that. Simple as that. Now here I am not writing the narrations. Okay, narrations are simple. In the bracket you have to take, you know, being business started with cash. Yeah, here being money deposited into the bank. You can write it in your own words. Okay, it doesn't matter. There is no marking for that, but you have to write it. Yeah, if you don't write it, then you will lose the marks. But you know, for the content, that it doesn't have marks. Yeah, it's just that it's just a requirement. You just have to make that narration there. Yeah, it's just a summary. In your own words you can write that, you know, being goods purchased for cash 5,000. Yes, some summary you have to write. Yeah, so you can see that in your book and you can look at that. Yeah, then let's see the next transaction. See the next transaction over here, fourth one, sold goods 50,000. Now you are selling the goods. So if you are selling the goods, yeah, then which accounts are affected? See here, you have sold the goods, and you have to assume this is a cash transaction, yeah, because they haven't said anything else, right? So you have to assume this is a cash transaction. You have got the cash because you have sold the goods, and the another account that is being affected is sales account, yeah, sales account and cash account. So now here what is happening to the sales account? Your sales have increased and your cash is also increased, yeah, both of these accounts are increasing. Now sales is what type of account? I have told you sales is revenue account, yeah. If revenue is increasing, what you have to do? You have to credit that. If revenue is increasing, you have to credit that. And cash is also increasing because cash is coming into the business, so cash is an asset account. If it is increasing, you have to debit that, isn't it? So the entry would be very simple: cash account debit, cash is increasing, asset is increasing, debit. And then sales is what? Revenue account. If revenue account increases, you have to credit, isn't it? Yes. So sales account will be credited 50,000, 50,000. Simple as that, yeah. Then the fifth transaction, see the fifth transaction properly, this is very important. Bought goods, yeah, bought goods means what? Purchases account is affected. Directly you should come to know that whenever you see goods word, that means those goods are meant for resale, okay? So if it is meant for resale, then purchases account is affected. Bought goods from X, 55,000. Now here this transaction is a credit transaction. This is what? This is a credit transaction. Why? And what does it mean by credit transaction? It means that you have purchased goods from this person X and you haven't paid the money, yeah. You have promised him that you will pay him later, okay? That's called credit purchase, yeah. You are purchasing goods on credit, 55,000. So now whenever this happens, you know what happens is, yeah, purchases account is affected. That's one thing. And one more account that is affected is this account, this person account, X account, yeah. Now who is this person X? See here, see this, you have purchased goods on credit, yeah, purchased on credit. Whenever you purchase something on credit, then what happens? You have to pay to this person in future, isn't it? The liability is arising over here, an obligation is arising. Now we have a present obligation to pay to this person, and this person will be our creditor because we owe money to him, yeah. So this creditor is liability. It is what? Liability. We have to pay to this person. So that's why. So liability has credit balance, right? So if liability is increasing, you have to credit that. So here this X person is our creditor and liability is increasing, so you have to credit his account, all right? And then what happened in the same transaction? Purchases account, right? So purchases is what? Purchases is expense, yeah. Purchase account is an expense. So if expense is increasing, you have purchased the goods, right? So purchases account is increasing, so you have to debit that, yeah. So the entry would be very simple. See here, the entry would be purchases account debit, yeah, expense is increasing, debit to X account. Now who is this X person? This person is your creditor. This is liability account, all right? So if liability is increasing, you have to what? You have to credit that, yes. So X account will be credited 55,000, 55,000. Simple, all right? Okay. Then the sixth transaction, see here, sold goods to Y, 30,000. Yeah, you are selling the goods to Y, yeah, to this person, and this is a credit transaction. This is also a credit transaction. Why is that? See here, I'll tell you one thing. Whenever you go to a shop, right? Whenever you go to a shop and you purchase something, let's say you purchased a pen, yeah, 10 rupees pen. So now, do you ask name to that person? What is your name to that shopkeeper? Or does he ask you what is your name? No, right? Because it's a cash transaction. You took the pen, you paid the money and you came home, right? But if, let's say, you went there and you purchased the same pen, 10 rupees or whatever it is, let's say 100 rupees, something you purchased of 100 rupees, a little bit big value, yeah. So you purchase something and then you check your wallet, you have left the wallet at your home only, yeah. You don't have the wallet. Fine. If you don't have the wallet, then what will happen? You will have to promise the shopkeeper that I will pay you later, isn't it? Yeah, you have to promise him you will pay him later. Then what will happen? This person will ask your name, yeah, he will ask your number, he will ask your address, isn't it? Of course they will, because they don't know you, right? And even if they know you, still they will ask everything, yeah. When are you going to pay back? What's your name and everything, yeah. So that's the thing. Whenever you purchase something and you don't pay money, then the name comes into the picture. Names, number, information comes into the picture. So whenever in transaction here in the question names are given, yeah, and they haven't mentioned cash transaction or something like that, then you have to understand that these are credit transactions. Yeah, credit transaction means that money is not paid. Yeah, it is yet to be paid, right? So here in the sixth transaction, what is happening? Sold goods to Y 30,000. You have made these sales, but these are credit sales. This your customer Y, he has not paid you anything. He is promising you to pay later. Yeah, he's promising you to pay later. This Y person, you have sold, you have made sales, isn't it? You have made sales, you have sold the goods, but he's promising you to pay later. So now this person will be called as debtor. This person will be called as debtor, and debtor is our asset. Why is it an asset? Because this person will pay us the money in future. So from this debtor we have a future economic benefit. So that's why this person would be called an asset. Debtor is an asset account. All right. Yes. So see here, sold goods to Y 30,000. Here two accounts are getting affected. One is the sales account, the revenue account. Yeah, revenue category. Yeah, and then the another account that is being affected is debtor account, Y account. Yeah, Mr. Y account. So Mr. Y is the debtor, and debtor is our asset. Yeah, because he will pay us money in the future. We have future economic benefit. So that's an asset. We have to debit that if it's increasing. Yeah, here it is increasing. Now see the transaction. Yeah, see, whenever you sell something on credit to somebody, yeah, here in case it is who? Mr. Y. Yeah, so that person who owes money to you, yeah, he has to pay money to you. So he would be your debtor, and it is an asset account. All right. So here the two accounts that are being affected is what? The first one is the sales account, and the second one is the Mr. Y account, or you can say debtor account or an asset account. Yes, but here we will use his name. Okay, Y's account, debit. Yeah, why debit? Why debit? Because see here, asset is increasing, right? He has to pay to us in future. Yeah, when we made that sale, right? When we made that sale, what happened? Immediately this debtor came into picture, isn't it? So this is increasing now. He has to pay us how much in this question? 30,000. He has to pay us 30,000. Yeah, 30,000. So now the debtor is increasing by 30,000. So whenever debtor increases, debtor means asset. Yeah, debtor falls in asset category, so it increases. You have to debit that account. So Y's account debit. Yeah, 30,000, and sales will credit because sales is increasing. You have just made the sales, right? And sales is what? Sales is revenue account. It's income, right? So you have to credit that. Yeah, Y's account debit 30,000, sales account credit 30,000. Simple as that. Yeah. Okay. Then seventh transaction. See here, what seventh transaction do we have over here? Seventh transaction is, see here, received from Y 30,000. Now after some time we have received the money from this guy. Which guy? Our debtor. We have sold, right? Previously we have sold goods to this person, wife. Now he has paid us that money 30,000. So now see here, before debtor increased, right? Debtor, he increased, isn't it? He had to pay money to us. Yeah, so it increased, but now he has paid the money. If he paid the money, now does he have to pay anything to us? No. So our debtor will get decrease. Yeah, before when we made the sales, he didn't pay us. He have to pay, right? So asset was increasing. Yeah, we were supposed to get money, but once we get the money, now we are not supposed to get anything. So our debtor account will get decreased, right? So whenever that decreases, debtor is what? It is an asset. If it decreases, you have to credit that. Yes, isn't that our rule? Whenever an asset, debtor is an asset, it decreases, you have to credit that. Yes, so that's what you have to do. See here in this transaction here, received from Y, what we have received? We have received cash. Cash account is being affected, and then the another account is the Y account. Yeah, the debtor is getting reduced. Yeah, he has paid the money, so our asset account is getting reduced. So that's why we have to credit Y's account. Cash account debit 30,000. We have got the cash. Yeah, cash is increasing, debit that. Asset is increasing, debit that, and to Y's account because we have what? Our debtor is decreasing. So that's why we have to, reverse his account. Here it was debited. Here you will credit and cancel his account because money is received. That's it. We are not going to receive anything more from this guy, from Y. Yeah, so we have to cancel his account. Debit equal to credit, it will cancel off. All right. Yes. Then the eighth transaction here we have is what? The eighth transaction is paid to X 55,000. Yeah. Now see, previously in the fifth transaction we had purchased goods on credit, right, from X, 55,000 worth of goods. That was a credit transaction. We promised him that we will pay in future. So now in the eighth transaction, if you can see, we have paid him. We have paid the money to this X person, our supplier. Yes. So once you pay to your creditor, yeah, your creditor from whom you purchased previously on credit, yeah, now you are making the payment, paid. If you pay him, then you don't have to pay anything more, right? Once you paid him, then that's done, right? The liability will get reduced. Yeah. If you pay to your creditor whatever money that was outstanding, if you make the payment, then you don't have to pay him anymore. Yeah. So the liability, the obligation will come down. The liability will get reduced. Yeah. So if liability reduces, you have to debit, right? So here you are making the payment to the X. Yeah. So X was your creditor, X account was your creditor account, liability is getting reduced. Yeah. Liability is getting reduced, and then what you have paid? You have paid cash. Cash is an asset. Cash is also reduced. So if liability reduces, what you do? Liability reduces, you debit that. Yes. See the rules. Liability reduces, you debit that. Yeah. See here, X account debit. Yeah. Previously here the liability was increasing. Yeah. You credited X account, but now here you have paid him. Liability is reducing. You are debiting it. And then the cash is also reducing because you are paying the cash. So if cash is reducing, cash is an asset, asset reduces, you have to credit that. Yes, credit the cash. 55,000, simple. Yes. Then the ninth transaction, see here, purchased building 7 lakh. Yeah, purchased building 7 lakh. Now here what is happening? Which two accounts are getting affected? A building account, of course. Yeah, because here you can see building, we have purchased the building. Yeah. And here they are not saying this is a credit transaction or something. Here they haven't taken any names or something from whom we have purchased the building. Yeah. So we can assume safely that this is a cash transaction. Yeah. So you can see that cash account is getting affected. Yeah. Cash account and building account. So here building is increasing. You have purchased the asset. Yeah. You have got the building. Building is increasing. Yeah. I mean the building account is increasing in values. Yeah. And then cash account is decreasing because you have paid the money. Yeah, cash account, asset account decreasing, credit that to cash account. But then what is building account? Building account is also an asset, isn't it? Future economic benefit is there. We can use that building in our business. Yeah, and we have a control over that. We just have purchased it. Yeah, we own that. So that's an asset. It is increasing, debit that. Simple building account debit to cash account. Yeah, the narration you can write anything, okay? It depends upon you, you know, being building purchase like that. Whatever you want, you can write. Yeah, it's simple. In your own words, you can write the narration. Then the 10th transaction, see here, sold furniture 30,000. Yeah. Now if you sell asset, now furniture is an asset. So if you sell the asset, then asset will get reduced. Yeah. So which two accounts are getting affected? Of course, the furniture account and the another account is the cash account. Yeah, because here we have sold the furniture on the cash basis. They are not credit basis. Here they are not given any names or nothing. Yeah, nothing they have said. So we can assume that this is a cash transaction. Same with the 9th transaction. Yeah, we can assume that this is a cash transaction. So two accounts which are affected are furniture account and cash account. Yeah, so we have got the cash because we have sold the furniture. So cash is coming into the business, cash is increasing, and then furniture we have sold it off. So furniture account will get reduced by 30,000. So if asset is reduces, credit that, credit the furniture account, and cash is also, no, cash is increasing. So you have to debit that. Yeah, cash account debit 30,000, cash is increasing, and then furniture, you have sold off the furniture, it is getting reduced. So when asset reduces, you have to credit that. Simple entries. Yeah, very simple entries. Yeah, these are the simple entries. In the coming videos we are going to, you know, see more advanced and club entries. Yeah, compound entries where, you know, 3 or 4 accounts are getting affected at once. So how to pass those entries and all we will see. So now you can practice. Yeah, see, it's very simple. Yeah, so just remember, whenever names are given, you have to assume that those are credit transaction, unless otherwise they have given cash somewhere. They have said, you know, bought goods from X on cash, so then it's a cash transaction. Yeah, they have just given the name just to confuse you. Yeah, so like that. And then you should know this also. Yeah, the person to whom you sell goods on credit, that is your debtor, and to the person from whom you have purchased goods on credit, that is your creditor. Yeah, you have to pay to this person, and this person debtor is supposed to pay you are supposed to receive the money. Yeah, this is an asset account, future economic benefit is there, you are supposed to get the money. And creditor means what? You have to pay, that's liability account. Yeah, keep that in mind. Yeah, see you in the next video. Yeah, so far we have seen a lot of things now. Yeah, just revise everything. Yeah, okay, then see you in the next video. Now this video has been a really long video. Yeah, okay, then bye.